Today is Monday morning, December 15th, 2025. We are reviewing last Friday's close. The Dow managed to hold up, small caps stayed relatively firm, but the Nasdaq was dragged down by AI and chip stocks. More importantly, Meta and Microsoft continued to weaken after the close. This wasn't a normal pullback. This was panic treating AI as a single risk bucket. The keyword today is separation. Hey everyone, I'm Peter. Today I want to make one thing very clear. This was not an AI bubble collapsing on the spot. This was the market emotionally selling everything as if it were Oracle. Your job isn't to panic sell, but to separate two groups, companies with real cash flow pressure and companies dragged down by correlation. If you can distinguish them, you get better odds. Structurally, last Friday was not a broad sell-off, but a clear split. The Dow and parts of value and cyclical stocks held up, while the Nasdaq and the AI complex saw the heaviest selling. Selling accelerated intraday, bounced near the close, but weakened again after hours. Rising volume and volatility suggest forced risk reduction, not rational repricing. That's why relative strength temporarily disappeared. This kind of market is easy to misread. On the surface, it looks chaotic, but it isn't. Capital is rotating. During panic, markets don't make fine distinctions. They focus on survival. Instead of guessing today's direction, watch what drops fastest, rebounds weakest, and keep selling after hours. Find where the emotional pressure is. Use structure to assess risk first, then fundamentals to identify opportunity. The real spark came from two earnings reports, Oracle and Broadcom. Oracle sent a signal of heavier spending and slower payback. Broadcom raised uncertainty around future margins and revenue timing. Together, they pushed the most sensitive narrative back into focus. AI bubble fears. It may not be the final conclusion, but it was enough to trigger a chain reaction. When markets shout bubble, they're usually not seeing the outcome. They're afraid of the process. AI gets valuation as long as returns are measurable. Once spending accelerates and payback becomes unclear, capital sells first and asks questions later. Certainty premiums get cut immediately. Even strong names get pushed down until selling pressure exhausts itself. Staying calm here matters more than being fast. Let's start with Oracle. The concern wasn't one number, but the combination. Revenue missed expectations, AI infrastructure spending surged, and free cash flow turned sharply negative. Trading desks translated it simply, spending looks like a black hole and cash is coming back slower. Once cash flow credibility breaks, valuation gets cut aggressively and selling spreads quickly across related names. Oracle's issue is cash flow structure, not whether it has AI. You can tolerate short-term losses, but you can't rely on debt indefinitely, especially when rates aren't near zero. Once cash flow cracks, markets shift into defensive valuation mode and reprice risk brutally. That's why sentiment flips so fast from enthusiasm to interrogation when AI spending gets questioned. Now Broadcom, the current results weren't weak, but the stock was still hit hard because the focus shifted to the future. Customized AI chips may pressure margins, and large orders contribute more slowly to 2026. The market concluded even strong companies could be dragged down by AI investment. In panic phases, good news can trade like bad news. Correlations rise and volatility spikes. There's a clear panic pattern. You say orders, the market asks margins. You say growth, it asks sustainability. You say future, it asks cash flow today. When emotion tightens, potential risks get priced as immediate threats. Strong companies get punished together until fear runs out. Your edge is patience. Wait for markets to return to accounting, not storytelling. That's where Wall Street made a critical mistake, selling all AI companies as if they were Oracle. Oracle faces slow growth and cash flow stress funded by leverage. Broadcom, Meta, and Microsoft operate on entirely different foundations, with stronger cash generation and clearer monetization, yet panic treated them the same, creating systemic mispricing. Panic selling isn't about value, it's about position management. Investors sell what looks similar, not what's wrong. Correlation replaces analysis. That's why panic often pushes high-quality companies into irrational discount zones. Your advantage is being slower. Wait for selling pressure to fade, confirm structure, then rebuild positions with fundamentals. We need to separate two groups. One group spends aggressively to catch up with uncertain returns. The other invests to scale already profitable systems with clearer payback. Last Friday's mistake was treating both the same and pricing them with identical fear. Different logic implies different risk, and ignoring that creates opportunity. My conclusion is simple. This wasn't an AI collapse. It was a purge of undifferentiated capital. The market punished laziness, not innovation. The more willing you are to separate businesses, the better your odds. One-size-fits-all selling usually marks opportunity, not the end. Build a mispricing list, and don't let emotion dictate strategy. Now, let's apply this to three names: AMD, Meta, and Microsoft. AMD was sold on valuation and competition fears. Meta was sold on CapEx concerns. Microsoft was sold on margin pressure. The common factor was spending fear, which overwhelmed their individual fundamentals and lumped them together with Oracle. For AMD, the key isn't whether it looks expensive today, but earnings elasticity and revenue diversity. CPUs, PCs, gaming, and data centers provide buffers during stress. What matters is execution timing. If data center products ramp, profits can follow quickly. Ignore headline PE and focus on delivery. Wait for selling exhaustion and key levels before re-entering. Meta is different. The fear is a repeat of 2022's spending cycle, but this time AI functions as a tool, not a gamble. It directly improves recommendation quality and ad conversion, impacting ARPU and cash recovery. This is measurable investment, not blind spending. User scale accelerates feedback loops, making monetization faster and more visible. I see Meta not as burning cash for the future, but as adding turbines to a printing press. Selling it like Oracle is a classic misfire. Focus on revenue lift per dollar invested, not headline CapEx. If ad efficiency keeps rising, cash flow will confirm it. When emotion fades, valuation will realign with that reality. Microsoft faced fears of oversized AI spending and margin pressure, but its strength lies in multiple monetization paths: Azure, subscriptions, Copilot, security, and enterprise bundling. It's not betting on one product, but embedding AI into enterprise workflows. Customer stickiness and switching costs make short-term sentiment less relevant. If Microsoft gets sold like Oracle, that tells you this is emotion-driven pricing. Its cash flow base, diversification, and resilience remain intact. AI spending here is strategic reinforcement, not collapse risk. Panic cuts certainty premiums first, but once markets calm, they ask a simple question: who is already turning AI into cash? Microsoft is one of them. The core takeaway remains: this wasn't an AI bubble bursting, it was emotional mispricing. Markets move through repair, then differentiation. Repair depends on liquidity and buybacks. Differentiation depends on cash flow, order conversion, and earnings quality. Performance will hinge on whether you layer businesses correctly before the split becomes obvious. My execution plan is straightforward. Isolate Oracle-type risks using cash flow and leverage. Build a mispricing list of cash machines and high-elasticity names. Don't chase the first bounce. Wait for selling pressure to exhaust and key levels to hold. This market sold and differentiated fear, not AI itself. I'm Peter. We'll keep breaking it down next time.